Okay, so confirm that we are back. We have 1 hour for VAT, so we must be able to cover it in 1 hour and move to the next thing. That's why we can't have any second. So VAT, again, it is cutting across both paper 17 and paper 11. Now for VAT, you actually need 2 things. You will actually need sales, and you also need purchases. And these sales and purchases are the ones that are going to create the VAT equation. Now, before you even get into the details, you must know how the VAT equation runs for you to be able to do it in the exam. So the starting point is, how does the VAT equation run? And I want you to see this last part that I have called summarized VAT computation. Summarized VAT computation down here. So in the summarized VAT computation, because you have 2 parts of your calculation, you're going to have the summarized computation and then the schedules, where you're going to draw your output and where you're going to draw your input. But whatever you draw in the output schedule and the VAT, rather in the input schedule, must be summarized in a VAT computation. So the schedules you're running are not the computation. The computation is a summarized item or process where we actually have the output tax. So as you're doing your VAT, you must be able to calculate output tax. Where do we get output tax? On all sales that are standard rated. All sales that are standard rated will generate for you output tax. Then we have input tax. We shall see the variations on both output and input tax. But when you are successful at getting your output tax, you subtract your input tax, you'll be getting your VAT payable or claimable, and then you can see the different adjustments. And I want you to be aware of the adjustments, because the examiner is not just going to give you output minus input and then stop there. You could have other adjustments. So the formula runs as output VAT minus input VAT. You first get your first level VAT payable or claimable. On that figure, you're going to now remove the adjustments. The adjustments you're going to deal with, one is the VAT offset. And I tell students this is one of the free marks in VAT computation, because the VAT offset is going to be given to you as a statement. The offset from the previous month becomes equate in the current month, and therefore you subtract it from your computation. Then there are other adjustments, 2 other adjustments you're going to deal with in the VAT computation. One to do with the VAT that you have withheld from your suppliers, and then the VAT they have withheld from you. So after running the formula as output VAT minus input VAT, you get your first VAT payable or claimable. From that, you remove any offset, and then you add any VAT that you have collected, what you have withheld from others, and you subtract the VAT they have withheld from you. You'll be getting your net payable or claimable. Now, once you get to that formula, then we can break it down from the different schedules. I want everyone to understand that formula, so that when you get in, you know that whatever schedules I'm going to run, they must be able to give me the output VAT, they must be able to give me the input VAT, and when I subtract those 2, I get my first VAT payable, claimable, and then I remove these adjustments. The first deduction is for the offset that has come from the previous month, and then the second adjustment is you add any VAT that you will have withheld from your customers, rather from your suppliers. because you're the one paying the suppliers. And if you're going to withhold, you'll be withholding from your suppliers. And then finally, the VAT that they've withheld from you that relates to the previous month's supplies. Then you'll be having your net VAT payable or claimable. Now, I am going to do 3 things. Number 1, quickly, I am going to take you through things the way they are categorized. Because whenever I have shared this list of the things that are standard rated, the things that are exempt, the things that are 0 rated, some people have not even bothered to look at those lists. You cannot pass a VAT number unless you know how to categorize these items. You must know which one is standard rated, you must know which one is 0 rated, you must know which one is exempt. After doing that, and I'll quickly do that because we don't have a lot of time and the schedules are already with you. After doing that, I will tell you the things that you are likely to adjust in output and the things that you are likely to adjust in the computation of input for us to be able to get those 2 items. So I have summarized some of the items that have come through more often as standard rated items. Remember, there is no schedule for standard rated supplies, but there's a schedule for 0 rated and there's a schedule for exempt. Now, when you're in the exam, after drawing the other formula that we have talked about, after saying I want the summary of my output VAT, less input VAT, I get my VAT payable, claimable, I remove offset, I add back what I have withheld from others, I subtract what they have withheld from me, I now go back to the schedules as workings. The workings to see that I am able to generate output, I am able to generate input that I'm going to feed into my formula. Now, when you actually have the items they have given you, number 1 is that you must have a column for the description. Because in the description is where you're actually going to say, if they have sold sugar, you actually write there, sugar. But you must have another column where you're going to be indicating the tax treatment, whether that item is, because you have actually basically about 5 treatments that you must be aware of. There are items where you're going to tell the examiner they are standard rated. And when you say they are standard rated, it means they are going to generate output VAT. There are items where you're going to say they are 0 rated. The moment you say they are 0 rated, it means they will not have any output VAT. Output VAT will be 0. There are items you're going to say are exempt. Again, those ones will not have any output VAT. Then there are things they're going to say are deemed VAT. Deemed VAT, you're going to show the amount, but it's not going to be part of your output VAT. So remember that. Now, assume you have your first column. The second column is where you're putting the tax treatment, whether an item is standard rated, 0 rated, exempt, or deemed VAT. The next column, if I can actually let me illustrate that so that people are able to see what I'm talking about. So we say, let me first share this screen as well. Because the moment you master this, your game will be done. So I am drawing my columns. First of all, I have my cells. And this is where I'm looking for my output tax. So in the first column of cells, I'm going to have my details. I hope my screen is visible. I'm going to have my details. The second one, I will have tax treatment. And we say the options you have are either you're going to say that this item is standard rated. That is if you're satisfied that it is standard rated. You're going to say whether it is 0 rated. You're going to say whether it is exempt. You're going to say whether it is deemed VAT. This is strictly on sales. So this is your second column. Third column will depend on whether your sales amounts are inclusive or exclusive of VAT. So you will have an amount inclusive of VAT or amount exclusive of VAT, because the examiner will tell you whether the amounts are inclusive or exclusive. So the next column would be, if they have said that the amounts are VAT exclusive, you would say VAT exclusive amount. If they have said that it is inclusive, you would say VAT, let me first deal with this one, VAT exclusive amount. So the moment you say VAT exclusive amount, the next thing that follows is that you're going to say VAT rate. Now it would be different if you had said VAT, let me do them together. VAT inclusive amount. Here you'll be saying VAT fraction. So you must know the difference. Now, the moment you say VAT, assume I have one item called sugar. We know that sugar is standard rated. If I say this amount is exclusive of VAT, I will actually put the amount there that is exclusive of VAT. But the moment I put the amount, the rate that I'm going to put there is 18%, because I have said the amount is exclusive of VAT, but it is standard rated. It means the next item will be VAT amount. VAT amount. And for me to get the VAT amount from exclusive, I get the exclusive amount times the VAT rate. So I would be getting my VAT exclusive amount times the VAT rate, and automatically it gives me the VAT amount. And that becomes my output VAT. If they have said that it is inclusive of VAT, this is what would happen if I can do it on top here. If my amount was inclusive of VAT, I would have, for example, 118,000 as the amount inclusive of VAT. But my VAT fraction would be 18% over 118. And therefore, if I'm going to multiply these, I'll be getting this inclusive amount times the VAT fraction, and that gives me, did I put in equal signs? This is divide by, 18 divided by, what is the division? So equals 18 over, so that's it. Of course, in your exam, you're not going to have, sorry, this is not a percentage, this is an amount. So this that has become decimal points was only 18 out of 118. For me to maintain it the way you want to see it, I am going to remove this so that you see it. Since now I have the figure, I can actually have my figure as 18,000 here. But what I'm emphasizing, principle number one, your sales will either be inclusive or exclusive. When they are inclusive, you multiply by the VAT rate, and the VAT rate is 18%. When they say the amount is inclusive, you will multiply by the VAT fraction, and what you have is 18 out of 118, and then you get the VAT amount. That is principle number one. Number two principle that you have to remember in VAT is, if they give you any item, if you're running any item and you discover that that item has an element of deemed VAT. Deemed VAT. You will have to expand your columns. And your columns will be, I have details, I have tax treatment, I have VAT exclusive amount, I have VAT rate, I have VAT amount, and then deemed VAT. And I will pick one item. Assume I have an item here called cement. We know that cement is standard rated, not so. But if this cement is going to be a supply to a licensee, I have supplied a licensee are the players in the petroleum sector, mining and petroleum sector. If I have supplied to a licensee, whereas that cement was standard rated, it is now going to turn into deemed VAT. If I am a supplier to a contractor of aid-funded projects, or if the contractor is contracting with government in an aid-funded project, it is also going to be deemed VAT. So for you to know whether they are testing you on deemed VAT, two things must happen. Was the supply made to a licensee? Was the supply meant for aid-funded project? If the answer is yes, even that item that was standard rated changes character. Instead of you calling it standard rated, you now call it deemed VAT. The moment you call it deemed VAT, assume it was also the 100,000. The VAT that applies also is 18%. And ideally, you'd be getting the 18,000. But the question is, where do you place it? Do you place it in the column of VAT amount, or do you place it in the column of deemed VAT? This time, you're going to place the 18,000 in deemed VAT. Why are you separating them? Because the amount, whereas it is VAT, it is not going to form part of your output VAT. So you want to make sure that by the time you add this output VAT, the amount that was deemed VAT has not affected that amount. Because deemed VAT is not VAT that you pay to URA, because you did not correct it. Whereas the item was standard rated, whereas the item attracted VAT, it is not VAT that you're going to add into your output VAT, but the examiner would want to see how you have calculated it. The rate remains 18%, but the amount is treated separately in a separate column. How do you know that they are now testing you on deemed VAT? You'll see the examiner saying that you made a supply either to a licensee, or you're making a supply in an aid-funded project. Projects that are funded by donors, those are aid-funded projects or development partners. So remember that. So that is to do with deemed VAT. So I have finished the concept of inclusive and exclusive because you must know it. I have finished the concept of whether an item is zero rated, standard rated, or exempt or deemed VAT. We are going to see some of the items. But when something is standard rated, you either multiply 18% if it is exclusive, or 18 out of 118 if it is inclusive. When an item is zero rated, the rate that is going to apply is 0%. And therefore, the result will be 0. When an item is exempt, the rate is nothing. So you put a dash. You put a what? A dash, meaning it has no rate. And therefore, the VAT is also going to be a dash because it has no VAT. But you've already told the examiner that you know this is exempt. For deemed VAT, you indicate the rate, but put the amount in a different column. Now, I want to expand this. Assume that in these cells, the examiner has also told you that you are a withholding agent. If the examiner tells you that you're a withholding agent, it means you're withholding from the payments you're going to make. Who do you pay? Who do you pay? So the withholding that you're going to withhold is not going to be in sales. it is going to be in purchases. But if they tell you that some of your customers are withholding agents, it means in your sales schedule, you'll also have a column for withholding VAT. Not so. That is when they have told you that some of your customers who you're making sales to are withholding agents and you're not exempt. Because two conditions must apply for you to have a column of VAT withholding. In other words, for me to have another column in here of VAT withholding, VAT withholding or VAT withheld, VAT withheld. First of all, for this to happen, two things must happen. Number one, because I am selling to, I am selling to my customers, not so, and they are the ones that are going to pay to me. If they are going to withhold from me, two things must happen. They are designated withholding agents, and I am not exempted from withholding tax. Now, assume I was getting sugar from Kachira. Rather, I'm selling, these are sales. I am selling sugar to which trader do you know? I am selling sugar to Capital Shoppers Market, Capital Shoppers Supermarket. I have supplied them sugar, but Capital Shoppers is the designated withholding agent for VAT purposes. When I sell them sugar over 100,000, before they pay me, because idea they are supposed to pay me 100,000 plus 18,000. So they are supposed to be paying me 118,000. But if they are designated withholding agents and I am not exempted, they are going to withhold from me before they pay me. And that they have withheld from me, I must recognize it in my sales schedule. So what do? I count my VAT withheld and I must calculate 6%, 6% of which amount? Of the amount exclusive of VAT. VAT withholding is not on the VAT amount. That's warning number one. VAT exclusive, rather VAT withholding is not on the inclusive amount. It is on the exclusive amount, and the rate is 6%. This is what they have withheld from you. What they have withheld from you is going to be in your sales schedule. So there are things that could happen in your schedule. We have warned you of the VAT withholding. What are the conditions? My customer that I am selling to is a designated agent and I am not exempted. If I am exempted, then they cannot withhold from me. Condition number, rather, the other item, the other adjustment you like to see in your sales, deemed VAT, I've explained that. The other adjustment you have to deal with is either inclusive or exclusive. I hope you've understood this. Now, I am going to quickly take you through the items so that you can remember. If I see this item, I can easily tell whether it is standard rated, zero rated, or exempt. Quickly, then we'll go to the purchases. So, after understanding the structure of your schedule, because the structure of your schedule is going to be dictated based on what you've read through the question. If you know that the question will have deemed VAT, it means you have an additional column for deemed VAT. If your question has some withholding VAT, you have another column for withholding VAT. If it doesn't have withholding VAT and also doesn't have deemed VAT, where do you stop? On the VAT amount. So the structure will be dictated by what the question is asking you to do. Okay, now these are some of the common items that I have picked from your question papers, which are actually treated as standard rated. Number one principle is all other items are standard rated if they are not in third and fourth schedule. Because third schedule gives you all the items that are exempt. Fourth schedule gives you all the items that are zero rated. So it simply means anything that is not in the third and fourth schedule becomes standard rated. So what are the examples that you're going to find? For example, the supply of sugar, supply of wheat flour, supply of clothing, supply of rent, supply of security services, supply of capital assets. For example, you dispose of a motor vehicle, you dispose of a building, you dispose of any equipment. The moment you dispose of a capital asset, it becomes standard rated. Supply of professional services, because sometimes they are going to give you a number that is either on supply of goods or supply of services. And largely speaking, you will actually do one of the two. Either the business is in supply of goods or the business is in supply of services. So do not just confirm, do not only cram goods, and then when they bring a number on services, you say we did not study services. PAT is either on services or goods. Supply of imported. Now this one, I must talk about it separately. In your outputs, you'll have an item called VAT on imported services. Guys, be careful with this one. Warning number one, VAT on imported services is not mixed with your output VAT computation. VAT on imported services is not mixed with your output VAT computation. Why? Because VAT on imported services is not reduced by any input. When you add it in your output tax, it will be reduced by the input tax. And you could end up in a claimable position. Yet when you have VAT on imported services, you must pay. That's why they don't allow it to be part of the computation. You must calculate it separately. How does VAT on imported services arise? Whenever you import a service from a foreign service provider, I'll give you an example. If you do consultant services for me here and you're a local supplier, I am going to charge you, you're going to charge me VAT. You're the one charging me VAT when you're billing me. Because you are, for example, an auditor and you have provided audit services and a standard rated. When you're giving me a bill, you give me a bill including VAT if you're registered for VAT. Not so. But for imported services, now the consultant is coming from outside. He's going to give me a bill. His bill will not have VAT in it. Because for him, he's not a taxable person. He is a foreign service. He's not registered for VAT. He's not going to charge me VAT. But after getting his service, I must charge myself VAT. I charge myself VAT. In the local market, it is the service provider charging you VAT. In imported services, it is you charging your, that's why they call it reverse charge. So you charge yourself VAT at 18% and declare it separately from any other VAT. And that's what you call VAT on imported services. So if you're doing a number and they tell you that you imported a service, or the service provider, the person who provided the service, is a person coming outside Uganda, and it is not an exempt service, then what you're going to do is that you're going to calculate 18% of the gross amount of that service, what you pay to the foreign service provider, and that would be your VAT on imported services. And you show the examiner that this is VAT on imported services and is not going to be mixed with any other VAT. So you declare it separate. And that's what the examiner is testing. Yes. Yes. Now, that VAT, because you don't have any input on it, it is one of the exception VAT that you can claim now in your income tax return as part of your expenses. Remember, when you're claiming your income tax expenses, they must be exclusive amount. So you don't claim VAT in the income tax expenses, but when you incur VAT on imported services, it is a claimable expense altogether. The other normal VAT, whether it is at importation, whether it is on local supply, is not claimable in income tax, because the assumption is that you've already claimed it in the monthly returns. But VAT on imported services, because it was not claimed, you do not have any input tax, they allow you to claim it in your income tax returns as part of the expense. Have I answered you? Okay, good. So that was an item that I had to warn you about. So I have said I had reached as far as professional services, supply of VAT, imported services, supply of packaging materials, standard rated, supply of goods for own use. I also want to emphasize this. I am a supermarket. I am a hardware. Let me use hardware, it's easy. I am a hardware and I'm selling cement, but I'm also building my house at home. Do you think I am going to go to another hardware and buy cement? What am I likely to do? Pick cement from my hardware and go and construct my own house. My own house is not part of the business, but I have picked cement to use on my own house. We call that goods for own use. The moment you have goods for own use, you are going to charge VAT on them if they are standard rated. So if I pick cement from my hardware and I have not received any money from it, but I have used it for myself, I am going to take the market price of that cement and apply 18% on it, and then calculate output VAT that I declare as part of my output VAT. Indifference is when you have actually made a supply which is not at arm's length. At arm's length means this cement now, this time you're not the one taking it, but your father is also building his house. And because he's your father, the cement was at 30,000 and you gave it him at 10,000. We say that is a price that is not at arm's length. So sometimes the examiner is going to give you a market price, but also the price at which you sold the cement. You sold the cement at 10,000, but the market price is 30,000. What is emphasizing on is that you should adopt the 30,000 instead of the 10,000 for purposes of computing output VAT. Those are goods that are supplied at a price not at arm's length. So those goods, supply of goods for own use, if they are standard rated, you will apply the VAT. Supply of mobile phones, standard rated. Supply of cooking oil, standard rated. Supply of computers and data handling equipment, standard rated. Sale by auction, standard rated. Supply of diapers. Diapers are very, very common. Either baby or adult diapers, all of them are standard rated. You know why they are very common? Because they used to be exempt. Now they are standard rated. So whenever you see diapers, they are standard rated. Supply of cotton, seed cake, all production inputs into iron smelting belts. Some of them you don't have to cram them. Sale of auction, I've already talked about it. Taxable supplies that are gifted or donated to employees by employers. This is very common. Again, you are Nairo breweries. You are Nairo breweries. Beer is standard rated. On a Friday, each staff is given a crate of beer, and it happens. On a weekend, you give your staff a crate of beer. That supply is standard rated because you're giving away what is taxable, and therefore you must go ahead and calculate output VAT. Next, that is common, postage stamps. Not very common, but you should remember it. So, supply of software and equipment installation, services manufacturers. Now, I want you to see this next item, which says supply of goods and services to contractors and subcontractors of hydroelectric power, solar power, geothermal power, or biogas and wind energy projects. If I stop there, and I have not added for personal use, that supply becomes exempt. But the moment it is for personal use, if you supply to these guys and it's for personal use, it becomes standard rated. Supply of soap, washing, bathing, powder, etc. Supply of biscuits, supply of electricity, supply of handbags, supply of custody services, supply of television sets, radios, and other electronics, supply of building materials such as cement, supply of salt, supply of imported rice, supply of service apartments. Now, these are things that have been common in your papers as standard rated. Is this list exhaustive? No. Standard rated supplies cannot be exhaustive. What is exhaustive is zero rated and exempt. Zero rated and exempt. Now, if we go through exempt and zero rated, whatever other supply you don't find, it becomes standard rated. So, quickly, I want to take you through the zero rated are very few. So remember these ones. First principle when it comes to zero rated, and the common ones that they test. Every export is zero rated. Every export is, whether it is an export of service, whether it is an export of a good, it becomes zero rated immediately it crosses borders. So, number one, the supply of goods or services, where goods or services are exported from Uganda as part of supply. Now, I want to ask you, if a Congolese comes to Chukubo and buys goods from Chukubo, puts them on a bus to Mpondwe, and then he gets them from Mpondwe and crosses the border with them, is that an export? That is not an export. That is a local sale. An export is the seller supposed to actually process the export documentation and have the goods cross the border. If the guy from DRC comes in, because they normally come, they come here, purchase goods, put them on a bus, they drop them at Mpondwe and then cross them with bicycles and all that. That is not an export. An export, there must be a support of export documentation. So don't be confused by that. But the moment we prove that there has been an export, automatically the goods become zero rated. Even if they were standard rated here, they become zero rated. Two, the supply of international transport of goods or passengers and tickets for their transport. Every time you cross borders with transport, international transport becomes zero rated. For example, you sold goods to someone in DRC and you're also giving them transport services. The goods cannot be zero rated and the transport is standard rated. All of them become zero rated. Supply of drugs, medicines, and medical sundries manufactured in Uganda. Now, this one you must remember it. Because when drugs are imported, they become exempt. When they are manufactured here, they become zero rated. When they are manufactured here, zero rated. When they are imported, exempt. Supply of educational materials. You may not survive this one. Because examiners know that students think that stationery is educational materials. Ladies and gentlemen, stationery is not educational materials. The moment they say supply of stationery, automatically it is standard rated. If the examiner tells you that this is an educational material, then it becomes zero rated. If the examiner wants to be hard on you, he picks one of the items which are educational materials and brings them. So you must know, out of the stationery items, which ones qualify as educational materials. And examples are there. Crayons, stencils, colored pencils, chalkboard instruments, lead pencils, ruled paper, pencil sharpeners, school registers, or school books of soft or hard cover and in all sizes, chalkboards, chalk, examination paper, supplied to examination boards as end users, rulers, geometry stock, mathematical sets, examination envelopes supplied to examination boards as end users, erasers, ballpoint pens, science-related educational materials, exercise books with soft or hard cover, technical drawing sets, laboratory chemicals for technical teaching of science subjects, graph books, duplicating papers. So that is it. Anything else that is not in that list. By the way, the magic is you must be able to be sure that that thing is made strictly for education institutions. If there is any other stationery that can be used anyhow, like these diaries, they cannot be educational materials. These notebooks cannot be educational materials. So the general stationery is not educational materials. Educational materials are those items strictly that are really manufactured for use in education institutions. Next, that is zero rated, is supply of seeds, fertilizers, pesticides, and hose. And here I have seen the examiner testing pangas. Pangas are standard rated. Whereas hose are zero rated, pangas are standard rated. Supply of sanitary towels, menstrual cups, and tampons and inputs for their manufacture zero rated. Supply of leased aircraft engines, spare parts of aircraft, engine maintenance equipment and repairs zero rated. Supply of cereals, where the cereals are grown and milled in Uganda, zero rated. Supply of handling services provided by national medical stores in respect of machines and other supplies funded by donors, zero rated. Supply of aircraft, zero rated. So those are the only items under zero rated. The rather exempt is where you actually need to pay more attention. And this is how you actually, if you can't remember them, at least guess. This is how you're going to guess. Most of the services that we call services that are essential services are largely exempt. What are the essential services that we're talking about? Health services are largely exempt. Educational services are largely exempt. Social welfare services are largely exempt. So health services, anything to do with health, anything to do with agriculture, anything to do with education, anything to do with insurance, and with the insurance and financial services, they have actually limited them, but largely they are exempt. But let's run through quickly because you could actually remember some of them. So what are those things that are exempt? Now, when you get an exam, first ask, what industry is this number in? If this number is in the health sector, you know the largest number of items are going to be exempt. If this is in the education sector, again, all the services in the education sector are likely to be exempt. If it is in the financial sector, banking sector, for example, or insurance sector, again, the biggest number of them are exempt. So once you know the industry, it is easier for you to guess right. If you know how to cram, then cram. So let's look at some of the exempt supplies quickly. Supply of livestock and processed foodstuffs and unprocessed agricultural products except wheat grain. So if I am an examiner, whereas wheat grain is also unprocessed, I will test you on wheat grain because I know then wheat grain becomes standard rated. The other item when processed and remains exempt is processed milk. Because some students cram that as long as I see unprocessed, as long as when I see unprocessed, it becomes exempt, but when I see processed, it becomes standard rated. No, with milk, even when it is processed, it still remains exempt. Don't ask me why, but it is exempt. So supply of livestock and processed foodstuffs and processed agricultural products, except which grain. Number two, the supply of financial services. Number three, the supply of health insurance services, supply of life insurance services, supply of micro insurance services, supply of reinsurance services, supply of aircraft insurance services. So largely speaking, insurance is exempt, but the general insurance is not exempt. Next is supply of an improved land. It then simply means when the land is improved, it becomes standard rated. The supply by way of sale, leasing, or letting of movable property other than, now pay attention to that one. When you sell or rent out, leasing is the same as renting. When you sell or lease out commercial premises, it becomes standard rated. That's why the guys in arcades are charging rent, whereas the guys with apartments where we sleep, they don't charge VAT, because we are saying sale or lease or letting of commercial premises is standard rated. A sale, lease, or letting of for parking or storing of cars, those who own parking slots in the night, you charge VAT. A sale, lease, or letting of hotel or holiday accommodation. If you're in a hotel, when you sleep in a hotel, they will charge you VAT. A sale or lease of letting for periods not exceeding 3 months, like those guys who have A and B, they charge VAT. A sale, lease, or letting of service apartments is the most current. So we have a case that has come through on service apartments. So if they examine on service apartments, you know they attract VAT. Next, supply of educational services, exempt. Supply of veterinary, medical, and dental nurse and nursing services, exempt. Supply of social welfare services, exempt. Supply of betting, lotteries, and games of chance, exempt. Supply of goods as part of the transfer of a business as a going concern by one taxable person to another taxable person. That is very common, and there is a serial number on it. How do you pass the test of a business being sold as a going concern? There are conditions that must be fulfilled. Supply of burial and cremation services, supply of precious metals and other valuables to the Bank of Uganda for State Treasury, supply of passenger transportation services other than tour and, when you're in tour and travel, it is standard rated. But these taxis that you board and the buses, the service is exempt. Now, those of you who have fuel stations, if they give you a number on the fuel station, the only thing that is chargeable to VAT on fuel station are lubricants. All other supplies are exempt. Fuel, whether petrol, whether diesel, whether kerosene, all those are exempt. But when you sell lubricants, they become standard rated. So when you're doing a number on a fuel station, you know that lubricants are standard rated, all others are exempt. Supply of dental, medical, and veterinary goods. You can't fail to have something in this list. But if you can remember them, I told you if anything is attached to the hospital, there is almost 98% chance that it is exempt. Now see the things that we are talking about. We are talking about things like, for example, dental, medical, or veterinary equipment. We are talking about ambulances. We are talking about contraceptives of all forms. We are talking about maternity kits, what we call mama kits. We are talking about medical examination gloves, medicated cotton wool, mosquito nets, acaricides, insecticides, and mosquito repellent devices, disposable medical face masks, and reusable face masks made of fabric. Medical boots, guys, medical boots and gum boots are totally different things. Gum boots are standard rated. Medical boots are exempt because they are attached to medical. I saw students asking me, but you see, we have seen boots this side and gum boots this side. Yes, gum boots are standard rated, medical boots are exempt. Medical impermeable aprons, stroke, coverall suits, bouffants, non-woven surgical cap, protective goggles with indirect side ventilation, infrared thermometers, motorized fumigation pumps, oxygen cylinders, body bags, biohazard bags, container. The reason why I'm reading the details of this is that the examiner picks one of these items and then you're like, where did I see it? So I'm helping you see it. At least when you see it now, by Thursday you could be saying, I saw this item somewhere. So I'm not wasting time because I know some of you have not gone through these things. And I'm increasing your chances of remembering them. So I don't normally take time to go through this list, but I know now you're wondering where are these items. So I want you to actually remember them because the moment you know how to categorize these items, the other computations become easier. So container used sharps, leak-proof, disinfectants, sanitizers, etc. At the back of your mind, ladies and gentlemen, if you want to cram, just remember if it's an equipment to do in the hospital, it's going to be exempt. So let's move to the next item. So the next item is supply of animal feeds and mixed components such as eggshells, feed additives, wheat bran, maize bran, premixes, concentrates, and seed cake. Next one is supply of raw materials and inputs for manufacture of the following: disposable medical face masks, reusable, again, they are things of the hospital. When you see them, please see them. Then there are also what you call agricultural tools. Supply of machinery, tools and implements suitable for use only in agriculture. And for the purposes of this subparagraph, machinery, tools and implements means, now these items you cannot fail to have one. First, knapsack sprayers, especially when they bring you a number on agriculture. These are some of the things you will see. Knapsack sprayers, ox plows, drinkers and feeders for chicken, agricultural tractors, including walking tractors, discalers, cultivators, plows, weeders, seeders, planters, subsoilers, drills, slashers. Have you seen the word slashers? Now they bring these threshers. Have you seen the spelling of threshers there? And then the thrashers. Thrashers are standard rated. Threshers are exempt. Someone is asking what is the difference. The other thrashers are SLATHES. Slashers, those ones that we use to cut grass. These slashers are actually attached to machines, agricultural machines. So these are agricultural tools. The other slasher can actually be used anywhere. Because I've seen questions where they're actually asking you about pangas and slashers. Those are standard rated. Then we have bell wrappers, milking machinery, milk coolers. Of course, you can know anything attached to milk will be exempt. Don't even argue with me. So maize millers, wheat flour millers, homogeneous, dairy machinery, etc., etc. The list is endless. Let's move to the next item. The next item is supply of crop extension services. As long as, by the way, it is a service, just know if it is falling in those sectors I told you, it is likely to be exempt. Supply of irrigation works, sprinklers and ready-to-use drips. Supply of deep cycle batteries, solar lanterns and raw materials for the manufacture of deep cycle batteries and solar lanterns. Supply of agricultural insurance premium stock policy. Supply of an electric vehicle. Again, you know, electric vehicles are the order of the day in Uganda. So the supply of electric vehicles, locally manufactured, or supply of frame and body of an electric vehicle or locally fabricated is exempt. Supply of electric vehicle charging equipment is exempt. Supply of cooking stoves that use fuel ethanol assembled in Uganda, exempt. Supply of photosensitive semiconductor devices, etc. Supply of life jackets, I have seen that more often in your exam. Supply of life jackets, life-saving gear, safety head gear, and speed governance. Supply of goods and services to the contractors and subcontractors of hydroelectric power, we had already seen that. Supply of Bibles and Qurans and textbooks. Supply. Now the other thing that you must remember under exempt supplies are those supplies made to investors. If you say supply and they are describing it as the supply to the investor, either industrial parks, you just know that it is exempt. Industrial parks and free zones. The guys that have invested in industrial parks and free zones, if you make a supply to them, largely speaking, it will be exempt. Okay, let's get out of the details now. I want to come back to my computation. So that was output items. What I have not talked about output are credit notes. Credit notes. When you have a credit note reduces your output. So the VAT on the credit note is going to be knocked off the output schedule. The other thing on output is the discount, trade discounts. As you're not writing these things, I told you whatever I am telling you, I am telling you things that are clear. Trade discounts. When they give you a trade discount, when you're the seller and you've given out a trade discount, you calculate VAT, output VAT on amount reduced by that discount. In other words, you first get the amount, knock off the discount, what remains is what you use to calculate output VAT. In other words, the trade discount affects your price for purposes of calculating VAT. I am done with output. I am now going to go to input. Input is on three things. Remember them. It is on local purchases, the things you purchased here on the local market. It is on imports, the things that you imported. And it is also on administrative expenses. So the VAT that they charged you when you were importing, the VAT they charged you when you are buying here on the local market, the VAT they charged you on your administrative expenses, when you combine it, it becomes your input VAT. And the input VAT, remember, is subtracted from output VAT. However, there are adjustments in input VAT you must always remember. At the back of your mind, the way you categorize sales is the way you categorize purchases. Whatever was standard rated, if it is a sale, it is also standard rated as a purchase. Whatever you actually categorize as exempt, it still remains exempt. But what are the things we test in input VAT? Listen to these things. Okay. There is input VAT that you're going to incur, but you cannot claim. You incurred it, but you cannot. And in the exam, the examiner wants you to actually write the word either non-claimable or not creditable. Some students were asking me, what is the difference? The difference is that you cannot claim that. Every time you suffer input tax, we call it your credit. So it is either creditable to you, meaning you can reduce it from output, or it is not creditable to you. So when the law has said that even if you suffered it, you cannot claim it, it means it will not be part of your input tax. You will show the examiner that it is not creditable, not claimable, or non-creditable. Whatever word you want to use. whatever is easier for you in English. If you say non-creditable, non-claimable, not creditable, they mean the same. So what are the common ones? Number one, we have what you call passenger automobiles. Passenger, in simple terms, ladies and gentlemen, passenger automobiles are vehicles. But the vehicles that we are calling sitting, vehicles that are meant for passenger transport. It can be a bus, it can be a minibus, it can be a staff van, it can be our private vehicles, the Land Cruisers, the Mercedes Benzes, the Harriers, the Golfs. Once you buy that vehicle as a company or as a person who is registered for VAT, and they charge you VAT, including the repair of that vehicle, including the spare parts of that vehicle, every time they charge you VAT, you cannot claim it. So when you see the examiner in input tax saying that you purchased a motor vehicle of the kind that passengers sit in, irrespective of its name, whether staff van, whether minibus, whether whatever it is, you know that they are testing you on passenger automobile. And you will indicate to the examiner that this input tax is not claimable. Number two is on entertainment. By the way, in number one, in passenger automobile, the only time you're going to claim input tax is either you're in the business of buying and selling those motor vehicles, for example, if you're a bond, or you are in the business of tour and travel. But other than that, these other businesses, the moment they actually buy a passenger automobile, they will incur input tax. Either you imported it, they charged it on you, but you cannot claim it. When it comes to the next item to do with entertainment, what is included in entertainment? They have bought you food, they have taken you for team building, they have thrown a party on you, and they have incurred some input tax. That input tax that they have incurred cannot be claimed unless you are in the business of entertainment, or they have provided meals and refreshments, all staff on an equal term basis and in premises operated by the employer. When it comes to telephone, we limit the claim to 90%. And how do you calculate the 90%? You get the telephone bill, assume it was exclusive, you first apply 18%, get the VAT amount, from the VAT amount, apply 90%. That is what you claim, because we are disallowing 10%. Next is payment for entertainment made by a taxable person for membership of a person in a club, association, or society of sporting, social, or recreation nature. Assume they tell you for membership in golf course, you have to pay 1 million inclusive of VAT. If you're paying for your MD, the VAT they have charged you because you're paying for his membership at golf course is not going to be claimable, because that is for recreation. So those are some of the limitations when it comes to input VAT. Remember these ones: passenger automobile, entertainment, telephone limited to 90%, and then payment for entertainment for membership of a person in a club, association, or society. What else should you remember? Please remember this. Remember. I had already talked about supply of important services. I won't repeat it. Now, the other free mark is salaries and wages. Whenever you see salaries and wages, the examiner wants only one word: out of scope. It is like a free mark because it comes all the time. Salaries and wages, if they are part of the expenses you incurred, then they become out of scope. Then cram this. All other administrative expenses are standard rated, except the rate where you rather except the telephone where you're limiting it to 90%. But all others, all administrative expenses are largely standard rated. Talk about rent, talk about electricity, talk about water, talk about whatever you think is administrative expenses. They are largely standard. Pardon? Yes, airtime is the same as telephone. So the way you treat airtime and telephone is the same, because we are actually limiting your airtime bill. So whatever you limit on telephone is what you limit on airtime. Okay, I had already talked about the concept of inclusive and exclusive, so I won't repeat that. I have talked about the component of credit notes. I would now I want to talk about. I talked about withholding VAT. I won't repeat that. I talked about deemed VAT. I won't repeat that. I am now going to talk about one last item, and that is to do with apportionment of input VAT. Apportionment of input VAT. Please listen, and listen properly. When you have finally calculated your input VAT after applying those principles that I've talked about, and you have your table of input VAT, that would be the total input VAT you wanted to claim. But the question is it all allowable? Can you claim all of it? Remember, you've already gone through the adjustments. You've knocked out everything you need to knock out. And now you have input VAT that you want to take to your computation of output minus input. The last question you ask yourself, when I was drawing my sales schedule, did I have any exempt sales? The moment you have any exempt sales in your sales schedule, you must do what you call apportionment of input VAT. So students who are asking me, when should we apportion VAT, input VAT? You apportion only and only if some of your sales are exempt. Why? Because the law says that if you're dealing in purely exempt sales, you cannot claim any input tax. But what if I am dealing in exempt and also taxable sales? So it means the input that I have, it must be apportioned so that I only take the input tax that is relevant to taxable sales. And for you to be able to do it in an exam situation, you would have to use this formula. This is the formula. This is easy to apply. Already you had your input tax schedule where you got your total input. So the total input is known because the assumption is that you already picked it from your input schedule. But you want now to apportion it. So what formula do you use to apportion that total input? This is the formula. You get your numerator, now the numerator is total taxable sales when they are exclusive. And taxable sales means the total of standard rated and zero rated. Standard rated and zero rated. Remember, deemed VAT at that point is also taken to be standard rated because ideally they are deemed, they are standard rated. So even deemed VAT are taxable supplies because we are looking at taxable supplies. So the numerator is a combination of all taxable supplies. So standard rated plus zero rated, and if you have any elements of deemed VAT, you also add them in the sales figure. We are adding sales amounts and we are adding them when they are exclusive. It means if your sales had been inclusive, you first look for the exclusive amount. I hope by now we know how to get the exclusive amount out of the inclusive amount. Because we know when you have inclusive to get VAT, you multiply by 18 out of 118. But if you want to get the exclusive amount, you multiply by 100 out of 118. Or simply, if you're lazy, get what was inclusive first, remove the VAT component. It is as easy as that. But make sure in the formula, you're only dealing with exclusive amounts. So we've agreed that the numerator is total taxable sales. The combination of standard rated plus zero rated, and if there are any deemed, you also add it there. Then the denominator, the one below, you know, some people have forgotten math. The one below the denominator is the total sales. So the total sales means now a combination of your standard rated, your zero rated, your exempt, your deemed, whatever category of sales you have, you add them together. Now, this one is going to give you a ratio, because the question you're asking, out of your total sales, which ones are taxable? Which percentage are taxable? It simply means, the law continues to say, that when you get this ratio, because the ratio is total sales over, rather total taxable sales over total sales. If you dare multiply it by 100, you get a percentage. And the law says, if the percentage you've got here is below 5%, if the percentage you've gotten here, before you multiply by input tax, if the percentage you get here before you multiply by input tax is 5% and below, do you know what that means? That your taxable sales only is less than 5%. That is what it means. The law says, unfortunately, don't claim any input tax. So you will give that person zero input tax, even when you calculated the input tax, because this formula has given you 5% and less. If this formula gives you a percentage more than 95% and above, you're simply saying over 95% of my sales are taxable. So there is only a small part that is exempt. The law says don't even apportion, take the whole of input tax. So 95% and above, you claim all the input tax. 5% and below, you lose all the input tax. So when do you apportion? You apportion when the percentage is between 5 and 95. If the ratio I've gotten here is, say, for example, 75%, I am going to get 75% times the input tax, and that is what I can claim in my computation of input tax. Have we understood it? Of course, the other alternative is called the standard alternative method, but they will not ask that in the exam because it requires different steps that you cannot do in the exam. But understand that there are two apportionment methods, standard method and standard alternative method. I want now to pick some questions on VAT, and then we can stretch for 5 minutes and come back here. Okay. Any questions here? The magic in VAT, I told you there are only three steps. Do the computation, the summary computation, output minus input, get your VAT, payable, claimable, adjust it for VAT, offset, adjust it, add the VAT that you have withheld from others, remove the VAT they withheld from you in the previous month, and then get the unit. When you're drawing your schedules, draw the schedule for sales, draw the schedule for purchases, and get your input. If some of the sales are exempt in your sales schedule, make sure you remember to do the VAT apportionment. Okay. Do you want a break or we can still move? We continue. Stand up if you want, stretch, and we proceed. We are now going to look at customs before we look at partnership. I want you to stretch, just stretch for 2 minutes. Because customs number is one number that I also want you to do. But I want you to do it when you're sober. When you make a mistake on customs number, you're good. And I will tell you why you'll be good. So guys, we are stretching for only 5 minutes and coming back here.
Hey, we are back.
Okay, so we're back. The small break was for only washing your face. Hey, we agreed that now that we are fattening the goats on the last market day, we must convince our heads that you can really put in these things and have them. And as you're doing the exams, you'll be hearing Jesus' voice in your ears. You're like, sometimes you want to close your eyes so that the voices are clear. And
Excuse me,
but as
Council,
you
before
close
you
your
proceed.
eyes, the time is moving. I've ever been dreaming and it's a good dream, and then all of a sudden you wake up and you want to go back and recreate the dream. Sometimes very, very hard. But you will get there. It's a matter of time. So we're going to look at a customs number, and I'm going to warn you about the things that you must be aware of. Because again, I was telling some of the students that we are trying to make sure that we increase our chances of passing by looking at numbers that are almost compulsory numbers in the exam. So the numbers that we have so far looked at, income tax is almost compulsory. VAT is almost compulsory. Fares you earn almost compulsory. I don't think that you've done so many question papers where those have missed. They are like the order of the day. So let's look at customs. Now, what is the question going to be asking, and what is the part that is going to give you the highest marks? The question is likely to, not likely. If there is a question on customs, this is what the question is going to be asking. In all papers, whether it is paper 17, whether it is paper 11, they are going to be asking you to determine the customs value, and after determining the customs value, you determine the customs taxes. So when you're doing a number on customs, these are the steps you're going to take. Let me first list for you the steps. When you ask a number on customs, you will take these steps. Please cram them for now. Cram them for now. So steps. So step number one. Step one is determine the customs value. Ladies and gentlemen, the principle of determining customs value, they are asking you, what is the cost that you incurred from where you imported the goods up to the point of first entry? What is the total cost that you incurred from wherever you imported the goods up to the first point of entry? Ladies and gentlemen, Uganda is a landlocked country, and therefore our point of entry is outside Uganda. Our point of entry is outside. When goods land Dar es Salaam like this, when goods land Mombasa like this, before they get off the ship, they have landed. So our point of entry is when goods have landed Mombasa before you remove them. The moment you remove them off the ship, any cost that happened thereafter is not part of the customs value. I repeat, when goods have come by water, by rail, the entry point is either Mombasa or Dar es Salaam. When these goods have come on a ship, for example, the moment the ship docks at Mombasa, we stop counting the costs. We then count the cost backwards until we go back to the country where the goods were imported. Meaning even the costs that are incurred at the port of Mombasa or Dar es Salaam are not part of the customs value. That is principle number one. So any costs that you incur at Mombasa or Dar es Salaam and coming to Kampala or coming to Uganda are not part of customs value and never include anything in the customs value. Now, All other costs going back, assume you imported goods from China. So the costs of the goods plus the auxiliary costs, so what you call the subsequent costs, or what you call the surrounding costs, to bring those goods up to the point of entry is what we are calling customs value. Now, if these goods have come by air, you also have to be careful. Because if these goods have come by ship, for example, you're going to have the normal cost of the goods. Assume I'm picking them from the factory in China. So there is someone who is selling them from the factory. After he has given me those goods, he probably puts them at the exit of the factory. For him, he has done his part. My part is I must be able to load those goods on trucks to be able to take them to the port in China, because they have to get to the port and then be reloaded on the ship, and the ship has to bring them to Mombasa or Dar es Salaam. So the costs within China, and those will include the cost of the goods, loading, offloading, airport charges, all those that are in China are part of the customs value. When they get to the shipper will charge you what you call freight charges. That word also confuses students. Freight does not mean the aeroplane. Freight can be on water, it can be on road, it can be in air. So when they say freight, it does not mean flying. Freight is transport. Are we together? So do not confuse freight with air freight. Those are two different things. Now, it includes the freight. The goods cannot come to Uganda unless they are insured. So you also incur insurance. That's why sometimes the customs value is called the CIF. Costs, and cost means the cost of the goods plus the incidental costs, but plus insurance plus freight. That is what they mean by CIF, or the customs value. And that is when I am using any other transport other than air transport. The moment I am using air transport, that CIF collapses to C and I. C and I means all other costs and insurance except freight, except the air transport. So in the customs value, we do not include in the air transport when we are looking for customs value if the goods have come by air. So step number one is that you must determine the customs value. Unfortunately, this is where the customs number becomes sweet or becomes sour. Because when the customs value is wrong, unfortunately, all the other steps are going to be wrong. Yet it is one of the easiest numbers. So assume you have the right customs value. What do you do next? Step number two. You compute import duty as number one. And how do you compute import duty? They would have given you the import duty rate. So that import duty rate, if it is 25%, multiplied by the customs value. So you realize that if customs value was wrong, import duty would be wrong. Step number three. Now, at this level, you ask yourself, are these goods going to attract excise duty, or they are not attracting excise? If the examiner tells you that the goods are attracting excise duty, it becomes tax number two. Because we have started calculating now the taxes. The first tax is import duty. The next tax is excise duty. But remember, not all goods have excise duty, and the examiner is going to tell you that there is excise duty. Now, excise duty is not a direct tax. It's you don't multiply the rate directly to customs value. You first compound certain things. You get the excise duty rate, which they have given you, excise duty rate. But you multiply that by a combination of customs value. You first add the import duty that you just calculated. What then does it mean? That if import duty is wrong, excise duty is also going to be wrong. That's why I'm warning you, when you're going to do a customs number, you must be sober. Very sober. Very easy, but you can actually mess with it. We proceed. Step number 4. Step number 4 is VAT. Now again, VAT is also compounded. You get your 18%, which is the VAT rate, times you first compound a number of things. And now you're going to combine the 3 that are up. Customs value plus import duty plus excise duty. That would be your VAT. Step number 5. Withholding tax. By the way, for VAT and withholding tax, you always know VAT is 18, withholding tax is 6%. So withholding tax rate, now this time you go back to Kawewe, customs value directly. The only confusing tax is actually only VAT and excise duty. But others, you multiply directly to customs value. Step number 6. Step number 6 is infrastructure levy. Infrastructure what? Infrastructure levy. Infrastructure levy is 5%. So infrastructure levy rate, infrastructure levy rate times customs value. Customs value. And you could also be asked to calculate what we call import declaration. Import declaration levy. This is 1%, and it's going to be import declaration levy rate, which is 1% times the customs value. This is when you are importing the general goods. When you're importing a motor vehicle, you will not have this item. And you will only add another item called, so step number 8, only for motor vehicles, you'll have what we call environmental levy. So environmental levy. Environmental levy. Only for motor vehicles. And how do you get that? Environmental levy rate, environmental levy rate times customs value. So you will not have excise duty, but the others will be available, and then you will calculate. Now, in the exam, the examiner will tell you the applicable taxes. Will tell you the import duty that is applicable, the VAT, the withholding tax, the infrastructure levy, import declaration, the environmental levy, excise duty, whatever is available. All you need to master is then how do I calculate for them. But you only calculate them after you have mastered. This one is the one that is killer. This one is the rope in the neck. Because once you master that and it's correct, you will actually finish a customs number within 20 minutes. And then you look at others. So let's see the killer items. So that you now master them and say, once this one comes, I'll be able to actually do it. Let's go and look at some of the things that you must be aware of. So number one note that you have to remember, if the number they have given you is for a motor vehicle, you might not be required to calculate the customs value because they might give you the URA's predetermined customs value. When they give you that, smile, because then you're very sure that whatever wanted to kill you, you're now safe. You're now safe. So whenever they give you the URA's predetermined customs value for motor vehicle, you start from there and adopt it as the customs value and then apply the taxes. So in other words, pray that you get the motor vehicle computation and then they have given you the predetermined customs value and then you move. Now, this is what is going to be included in the customs value, and this is what is going to be excluded from the customs value. Let me actually have the list. I think I generated the list for you here. Okay. So I have created a sheet that has items that should be included in the customs value and items that should never be included in the customs value. And these are the items that you must cram properly. So when you see an item in this column, it means whenever you see it, please never include it in the customs value. And there are not many, by the way. When you master them, it will be easier for you to get them. Because the first principle is any costs from the point of Mombasa, including the costs incurred at Mombasa, coming into Uganda, are not part of the customs value. Air transport is not part of the customs value. So let's see the things. And you remember them before the question. You remember them after knowing how goods come. You've gone to China, the assumption is you're going to pay for the goods. That price that you pay for the goods is called an ex-factory price. The other name of an ex-factory price is called the invoice value, or it's called the commercial price. The only thing that will affect that ex-factory price is when they gave you a trade discount. Guys, there are two types of discounts. One is called a settlement or cash discount. Another one is called a trade discount. The only discount that affects the ex-factory price is the trade discount. Because if I go to the market and I'm going to buy this pad, and I find the price on it is 1.5 million, and I bargain, and they deduct for me 100,000, it means the price that we are talking about is only 1.4, and all taxes will be based on 1.4. So the trade discount automatically reduces the price. Now, whenever you have the cost, sometimes they call it free on board, sometimes they call it the purchase price, sometimes they call it ex-factory price. If they told you that there was a discount, please knock out that discount first from the ex-factory price. That will be your starting point. Meaning the price would be net of the ex-factory price, rather net of the discount. That is the first item you include in your customs value. The other common cost that the examiner looks at is what you call pre-inspection fees. Remember, all these are happening in the other country. So all the costs that have happened in the other country, please remember them to be part of the customs value. So these include pre-inspection fees. They include insurance on board. That is insurance up to the point of first entry. Now I want to warn you, if these goods are coming on ship, the first entry is Mombasa or Dar es Salaam. So we are talking about the insurance up to Dar es Salaam. If you incur any other insurance from Dar es Salaam into Uganda, that is outside. If the goods came by air, the first entry point is the first airport in East Africa. So if these goods first enter the Jomo Kenyatta International Airport or any other airport in East Africa, that becomes the first entry point. If they are going to board again and come to Entebbe Airport, already the first entry point is hit at Jomo Kenyatta, meaning any other costs from Jomo Kenyatta to Entebbe Airport are not part of the customs value because the goods have already hit their first entry point. So if I insured the goods from China to Jomo Kenyatta International Point, and then I also insured them to come to Uganda, the insurance amount we're going to consider is up to Jomo Kenyatta because they have entered the East African territory. The next one is, now I want you to see this insurance. Insurance inland, e.g. from Mombasa to Kampala. We said the moment goods have hit Mombasa, any costs are excluded from customs value. Next, freight. And freight here we are talking about transport. Transport to the point of entry from China, for example, up to Mombasa is included if you're using any other transport other than air transport. If you're using air transport, it will not be included. That's why I'm saying freight transport to the port of entry is included. Packaging stock cost of the container is included. Shipping fees stock charges is included. Port handling services stock charges. Now be careful. Port handling charges. The other side, if they are the port handling charges at Mombasa, they are not included. So cram it from your head that any costs that happen at Mombasa, any costs that happen in Dar es Salaam, any costs that happen at the airport are not part of the customs value because the goods have already landed. So we are talking about the ports, the other side. So you see, for example, port handling services at Mombasa cannot be included, whereas the port handling services, the other side, say for example in China, are included. Training costs. I think so many students have asked me about training costs. Ladies and gentlemen, you must know where the training costs are coming from. Because what are they training on? Some imports cannot be made unless you have been trained on how to use certain items. And sometimes the manufacturers make it a condition of sale that they cannot sell you anything unless they have taken you through training. So if training cost is a condition of sale, it becomes part of the customs value. If it is not a condition of sale and the training is done here in Uganda, then how does it meet even the customs value, yet you've already cleared the goods? You realize the goods are going to be cleared at Mombasa. And at that Mombasa, that's when we're going to determine the customs value. If the training is going to happen here and it was never a condition of sale, then it cannot be part of the customs value. But if it is a condition of sale, then it is part of the customs value. Installation fees. When do we install the equipment, for example? When it has already reached here, not so. So can it be customs value? No, because by the time we do the installation fees, already the goods have already cleared for taxes. So installation fees cannot be part. Transportation to the port. Now, transportation to which port? We are talking about the port, not these goods have not yet entered the port. So any transportation from the port, whether it is the other side, whether up to Mombasa, is part of the customs value, because we are saying transportation to the port. For example, the goods from the warehouse must be transported on trucks to the port in China before they can actually get on the ship. Inland transportation, and inland means you've already reached Mombasa and you have to transport these goods coming to Kampala. That's what we call inland transportation. It can't be part of the customs value. Air transport, I have already emphasized it. It is not part of the customs value. Royalty. Royalty is a payment for an intangible asset. For example, brand. There are manufacturers who tell you they will not sell to you their goods. They are not going to sell you their equipment unless you're able to pay for their brand. And therefore you pay an additional cost called a royalty, because it is a condition for them to sell you the goods. So royalties become part of the customs value. What about storage charges in China? Part of the customs value. But if the storage charges are in Mombasa, then not. Storage charges at Mombasa, for example, no. Clearing charges, when do we do the clearing charges? We do the clearing charges at Mombasa or Dar es Salaam, and therefore they cannot be part of the customs value. Loan arrangement fees, this is outside the importation even. But I have seen the examiner test you on loan arrangement fees, that you are going to import the goods, you did not have the money, you had to process the loan, and therefore you incurred fees. That cannot be part of the importation. So it is outside the scope of importation. Demurrage fees. Demurrage fees is the cost you incur at the port of Mombasa or Dar es Salaam because you delayed to clear your goods. So it can't be part of the customs value. Then there are two things that you must remember. One is called buying or selling commission. Selling commission is included in customs value, but buying commission is not included. And this is how they differentiate. I am a buyer. I am the one who has gone to China to look for goods. Now in China, we have brokers as Ugandans. We have the guys that we reach to and tell them, and they are the ones that are going to connect us to different suppliers. Those are agents, our agents, and we pay them commission. That's called a buying commission. That is not part of the customs value. But the selling commission is now the seller incurring a cost to actually sell to you the goods. So the selling commission are part of the customs value, whereas the buying commission are not part of the customs. I have seen one of the numbers where they were actually talking about buying commission. So wherever you see buying commission, please don't include it in the customs value. So that is all you actually need to be aware of. The moment you know how to compute customs value, then the next thing is how to apply the rates. And I've told you the steps you take to apply the rates. Which ones are the common rates? On import duty, import duty can range from 0 to 100%. But the examiner is going to tell you which rate is applicable. But you as a student, you must know if goods that you have imported are considered raw materials, the rate is 0%. If they are considered semi-finished products, 10%. If they are considered finished products, and largely speaking, most of the goods that we import are finished products, that's why we apply 25%. But there are also what we call sensitive items where the rate goes beyond 25%. For example, if you wanted to import milk and cream, the rate is as far as 60%. For wheat grain is about 35%, wheat flour is about 60%, rice is about 30%, maize is about 50%, sugar is about 100%. This is on the import duty rate. Then the other rates that are relevant: VAT 18%, withholding tax 6%, infrastructure levy 1.5%, and then the environmental levy is going to be dependent on the number of years, and the examiner is going to tell you if you're importing a motor vehicle. But largely speaking, if the motor vehicle is below 9 years, you don't pay any environmental levy. If it is between 9 to 15, if it is a passenger motor vehicle, 50% if it's goods vehicle, less than 4,000 kilograms, 20% more than 4,000 kilograms, 20%, motorcycles, 20%. And if you have any vehicle above 15 years, they can't even allow it to come to Uganda. But even if they're asking you about vehicles, they'll give you all these rates. So do not worry. But as a student, remember them. So that when the examiner forgets to give them to you, then you know that the import duty is going to be 25%. Please remember this. Anything can happen in the exam. Import duty, you will apply 25% if the examiner is silent. VAT, you're going to apply 18%. Withholding tax, you're going to apply 6%. Infrastructure levy, you're going to apply 1.5%. And if they need import declaration levy, it is 1%. Okay. I think that is it for customs. It is an easy number, but it is a killer. If you mess up with, so if you want to try between now and Thursday, try about 5 customs numbers. If you're getting the customs value right, then you know you're ready to do a customs number, and don't miss it because it is one of the easiest numbers that you can do. Okay, next is partnership. Close your eyes, breathe, and come back. If me, I'm not yet tired, you must not be tired. Yes. If they have a value on them, you actually add it in the cost. Yes. Breathe in, breathe out, and we look at partnership. Someone is saying we are done breathing. Today we are doing what? We are fattening bull. I told you my target is 50%. I can see online, I see about 233 students. Plus, see, how many are you? You're about, who has studied the estimation? About 100 probably, or thereabouts. So if 333, I can achieve 50%. Even if I don't get 80%, I'll be happy man. But I am very sure, hey, by the way, I promise that if all of you get 50% minimum, I sponsor you for the beach. Of course, I'm talking about Capital College students. I might be overwhelmed by everyone. I might be overwhelmed by everyone. Even the 1 million is applicable to Capital College students. I might be quoted in the out of context and saying, when we are doing the pro bono, you actually promised 1 million. Our students are given 1 million if they hit 80%. That is what they're talking about. And that one is a promise that I can't break. Okay, so let's come back to here to partnerships. Let's pick a number on partnership and see how it is structured. Which year examine the partnership? Which year examine the partnership? May. So let's look at a May question. But it would be nice, even if you're not students of Capital College, to join us on a beach bash. It is when you release your stress, get ready for the next marathon. You relieve yourself, not so? So this is a typical number on a partnership. If I can share my screen now for you to be able to see it. That's the typical number on a partnership. Now, I want to emphasize certain principles that you must remember when you're doing a partnership number. Number one is they are going to ask you three major questions. These are the three major questions you must answer on a partnership. Number one, can you be able to determine the chargeable income of a partnership? Can you be able to determine the chargeable income of a partnership? Because this is step number one. Step number two, after determining the chargeable income, can you be able to determine the distributable profits or loss? After determining the distributable profits or loss, can you be able to determine the chargeable income of each partner? And finally, can you be able to determine the tax payable of each partner? So 4 things. Once you master those ones, you are good to go. Number one, determining the chargeable income of a partnership. Number two, determine the distributable profits or losses of the partnership. Number three, determine the chargeable income of each partner. And finally, determine the tax payable of each partner. Now, this is what you're going to have when you're examined on a partnership number. Again, the things that they gave you when we are dealing with number one on business income of a company are the same things they are going to give you. What are those things? They are going to give you the POL with the notes. And they're also going to give you, so they give you the POL, the summary, they give you additional information. And in the additional information, there is also information to do with capital assets or balance sheet assets, to do with plant and machinery, and also to do with the building. So the structure is the same. So if the structure of the question is the same, how does the format then change? Or what are the things that I have to change when I am drawing a partnership number? And my prayer to the students is that they bring you number one, for example, as business income of a company, and in the same exam, they also bring you a partnership. You will enjoy that exam because the same principles you will use to hit two birds with one stone, and you're going to see how. Now, when it comes to partnership, these are the formats that I want you to draw. Format one is the same format that we drew for a company, but I'm going to tell you the things that change in that format. Remember, we said step number one is for determining chargeable income. So here I would set the heading. For example, ABC partners, chargeable income and distributable profit for the year ended 31st December 2024. And then I start with my profit or loss before tax. Where am I picking it from? POL. Bring it in my third column. Then the next thing is I say add back non-allowables. Now, ladies and gentlemen, whatever we said is non-allowable remains non-allowable. But now there are unique things that are unique to a partnership. Remember, a partnership is made of partners who have come together to do business in common for purposes of earning and sharing a profit. Meaning the return of every partner is the profit that has been made by the partnership. What does that mean? However, in practice and reality, is that partnerships will usually pay some partners certain allowances. Partners will pick money from the partnership because after all, they see the business and themselves as one and the same. So during there, some partners get salaries, some partners can be paid interest on their capital, some partners can pick money for private expenses, some partners can pick anything, drawings, etc. So there are certain costs that are going to be incurred by the partnership but the money is entering into the pockets of the partners. So in other words, the partners are prematurely appropriating money from the partnership before we determine the profit of the partnership. So the question we first answer is, can you first determine the profit of the partnership before any partner picked money from the partnership? Can you determine the chargeable income of the partnership before any partner picked money from the partnership? What does that mean? That if you go to the POL, any expense that you see which was caused by a partner, which entered into the pockets of the partner, becomes a non-allowable deduction in the hands of the partnership for purposes of determining chargeable income of the partnership. In other words, we are trying to explore the reality. What should have been the truth? If you partners did not pay yourselves salaries, if you partners did not pay yourselves interest on capital, if you partners did not make any drawings, what should have been the chargeable income of that partnership? So that's what we do. So among the non-allowable deductions is that you're going to go to the POL. Anything that was paid to the partners becomes a non-allowable deduction. The only exception is interest on the loan. But other things, call them interest on capital, call it salaries of the partners, call it any private expenses or private allowances, as long as the partnership paid it to the partners, or as long as the partners picked it from the partnership, that would not have been an allowable deduction of the partnership, because partners are not allowed to pick money from the partnership. So if you get a POL, and among the expenses they have given you, they relate to things that were paid to the partners, you will come and add them back in the tax computation. And examples that you will see is interest on capital. Are partners supposed to be paid interest on capital? No, because they must wait for the profit. Number two, salary to the partners. Any salary that is paid to the partners must be added back. Number three, any drawings, if any partner picks from money from the partnership, it must be added back. And any other private expenses, the partnership is paying school fees for the partners, children's school fees, the partnership has paid some allowances, the partnership has paid some allowances to the partners have gone for a holiday, and it's the partnership paying. All those costs, we are saying they are entering into the pockets of the partners and prematurely. And therefore, if we want to determine the chargeable income of the partnership, we must first add them back. Appreciate that principle? Now, with all the add backs that we had, now add those items that are relevant to the partners. And then when you go to less allowables, also the less allowables that we had, you also consider them. If there are capital allowances, if there is rental income, if there is exempt income, all those that we actually considered as less allowables. But on top of that, partnerships, if they have earned the other four incomes, remember the other four incomes which have suffered withholding tax as a final tax, you will also bring them here and remove them, because partnerships are seen as individuals. And we said if in the POL there is interest on treasury bills or government securities, there is interest on fixed deposit accounts, that is from financial institutions, there is dividends, there is commissions, mobile money agents, or mobile money airtime distributors. Those four incomes are relevant to a partnership, and you knock them out of the tax computation under less allowables. That is also unique compared to the company. Okay, so after that, you'll be getting the chargeable partnership income. At this point, you have eliminated all the things to do with the partners. And you're saying, if the partners did not pick any money from the partnership, this should have been the chargeable income. After getting the chargeable income, ladies and gentlemen, after getting the chargeable income, there are free marks you earn. This is how you earn your free marks. When you're drawing what you call the appropriations account, where you're going to determine the distributable profits. How do you determine the distributable profits? The question you're answering is that I have already determined the partnership's chargeable income and eliminated all items that were paid to partners. At this time, you ask yourself, but is this money still in the partnership or the partners took it? Indeed, the partners took it. So you want them to see what remained after they had taken that money. So whatever you had added back, if I had added back interest on capital, I come back and subtract it now because I'm now looking for the distributable profits. That's why you earn 3 marks consecutively. What are the 3 marks? Whatever you have added back here as relating to the partners, interest on capital, partners' salaries, partners' private expenses or drawings, whatever you had added back, you now come back and subtract it after chargeable income. So whatever you had added back in relation to the partners, because now you're doing what we call an appropriations account. You're saying, I am going to debit the partnership account and credit the partners accounts. So whatever you subtract here, you go and take it in the individual partners accounts. That's why you have free marks, because this is how it is. Whatever I added back, I come back and subtract it. And I am not subtracting it under less allowables. Please don't mix these two things. Because where students make mistakes is that they now put them under less allowables. They are not less allowables. Those adjustments only come after chargeable income. And you only first determine chargeable income and then make those adjustments. You could actually say less adjustments. So those things that you had added back, come back and subtract them. As you subtract them, where are you taking them? You're taking them under each of the partners, because the next statement is you're going to draw each partner's accounts. So whatever, for example, let me show you one item. I have interest on capital. This was interest that was received by the partners, and it was a cost on the partnership. Because it relates to the partner, I am adding it back. After doing that, that interest on capital is going to be subtracted as an adjustment. When I subtract it, I take it under the partners that received that interest on capital, because for them, they are receiving it as income. I am knocking it from the partnership. I am bringing it to their individual accounts, because they are the guys I want to tax. So the 3 marks are, the first mark is for adding it back. The second mark is for coming and subtracting it. And the third mark is bringing it in the individual accounts. Now, before the distributable profit, I want you to see this. When we reached chargeable income, when we are doing the company, what did we do? We list carry forward losses. Please. Anyway, where are you going to get them anyway? We do not have a carry forward losses with partnerships. Partnerships don't have carry forward. Why? Because whatever the result was last year was distributed among the partners. So we had nothing to carry forward. So you never have carry forward losses. That's why when you get to the chargeable income, the next thing you do the appropriations account. And the appropriations account, you only look for those items that related to the partners, which you had added back, They are the things that you now subtract here, and when you subtract them here, you go and add them in the individual partners account. So this first statement helps you to do two steps. Step number one was for chargeable income. Step number two was to get the distributable profits. Is it possible for this one to be a loss? Yes, it can also be a loss. When it is a loss, you distribute it as a loss. When it is a profit, you distribute it as a profit. Now, the moment you reach here, you are done with the business of a partnership. You are now moving to step number 3. Step number 3 was what? Step number 3 was what? Determine the chargeable income of each of the partners. So what do? You come and draw the partners' individual accounts. So if you have 3 partners, for example, you will say partner A. Of course, you start with the description. You say partner A, partner B, and partner C. You might not need the total because no one wants to know the total. Each partner is on their own. Remember, each partner pays their own tax because the first principle is income tax is not paid by the partnership, but rather it is paid by the partners themselves. Now, you don't need the total here. But what comes into this? How do you determine the chargeable income of each of the partners? The first line is the share of the profit or loss. What are they sharing? What are they sharing? This profit you call distributable profit or, and how are they sharing it? Using the profit sharing ratios. So if, for example, A has 40%, you apply 40% on that amount. If B has 30%, apply 30% on this amount. If C has 30%, also apply it and bring it as your item number 1, because that is what they are sharing from the partnership. Item number next are all those things that you had subtracted, which you are now bringing into the partnership. So, for example, the salaries, and here I'm talking about the partners' salaries. Interest on capital, interest on loans. Now, interest on loans did not go through the tax computation because interest on loan is a normal income to the partner and it was a normal expense to the partnership. Because an interest on loan simply means over and above his capital contribution, the partner added in a loan, and that loan is taken as a special product other than the capital injection. So we actually take it, we allow the expense in the partnership, we don't touch it, but that income that has been earned by the partner is brought into his account because it is his income that we must tax. So interest on loans, if they made any drawings means they picked money from the partnership, it is already with them, bring it here, we want to tax it. Now, remember, these partners are in the partnership, but they could also be earning any other outside the partnership. And that income could be earned either in Uganda or outside Uganda. Now, when that income is not among the 4, remember the 4? Under 139, if it is not interest on treasury bills or government securities, if it is not dividends, if it is not interest from a financial institution, if it is not commission, then you will bring it here. But if it is among those, you don't bring it here. Because the assumption is it has already suffered withholding tax, and in the hands of the individual, it is final. You can't bring it here. So you bring any other income because they could do some consultancies either inside Uganda or outside Uganda. So whatever other income they have earned, please bring it here. Now, as you bring it there, you are now going to have, there's also what we call interest on drawings. Because if you pick interest, rather if you pick drawings, sometimes the partnership will charge you some interest. That becomes for you a cost. That's why it is in brackets. So interest on drawings is a cost. Then I am able to get the chargeable income. When I get the chargeable income of each partner, I am now seeing them as individuals. I'm now seeing them as individuals. So what do? I now ask, is there any individual that has a carry forward loss? Because for them, they can have carry forward losses. I knock it off from anyone who has it. And then I am able to get my adjusted chargeable. And from the adjusted chargeable income, I now go to the table. Remember the table for individual income tax rates? That's where I pick their tax from. I bring their tax there as tax payable. And then the next thing I remove are any credits. So can we guess the credits that are available to partners? Number one, foreign tax credit. If you know that among the incomes you have brought here is income that was earned outside Uganda, and this partner was charged tax, it is time to also bring the tax that he paid outside there is called the foreign tax credit. So you must remove it because you cannot tax the income again and not give him the credit. So you must bring the credit there. If they have paid any withholding, now for withholding tax, pay attention on that. For withholding tax, it is always going to be suffered by the partnership. But the partnership has no business with withholding tax credit. So this credit is shared among the partners using the profit sharing ratios. So when the partnership has withholding tax, it is going to be shared among the partners using the profit sharing ratios. Partners could also have been charged some pay as you earn. As they earned some employment income, either from the partnership, they could have also been charged pay as you earn. It is now their credit because you are charging them on tax again, on salary again. They could have also paid some provisional tax, you also remove it. So when you get the tax payable, you remove all the credits, you get the net tax payable that you are looking for each of the partners. All you have to remember are the 4 steps. Step number 1, determine the chargeable income of the partnership. Step number 2, determine the distributable profit or loss. When you're done with that, get out and then get into the table of each of the partners. For each of the partners, you'll be required to determine the chargeable income and afterwards apply the tax on it to be able to get the tax liability for each of the partners. Okay, that is now to do with the partnership. And unless you have any question on the partnership, ask, and then we can be able to look at something else. Yes. We said, let me show you. This is what I'm talking about. I want you to see the story that we have been talking about and how it is examined. For example, in this question, they are saying Albert and Ken is a leading accounting firm providing. I hope everyone is seeing the question. So Albert and Ken is a leading accounting firm providing audit and assurance accounting, tax and business advisory solutions, both national and international organizations. The firm is owned by 3 partners, Muganda, Kenneth, and Kiondo. It means when you're drawing individual partners, you're going to have the columns for one for Kenneth, another one for Maganda, another one for Kiondo. But they're also telling you that when you're going to share any profits or losses, you're going to use 40%, 40%, and 20%. Maganda and Kenneth are employed by the firm as managing partner and residence consultant respectively. In addition to providing accounting services, the firm rents out 5 floors of its 7-floor building, meaning it is also earning rental income, and therefore you must deal with rental income in the tax computation. Remember how you deal with rental income? Remove the rental income, add back the rental expenses, and then do a computation on rental tax. Now they have given you the POL, they have given you the notes. I want you to see some of the notes. For example, if you look at note number 2, they are telling you salaries. So they have a salary for Maganda, they have a salary for Kenneth, but they also have a salary for other. What problem do you have here in salaries? You only have the salaries for the partners. Those are the ones you're going to add back. When it comes to For example, interest. You are asking for interest. Is there any note on interest? Huh? Do you have any note here? Where? Note? Okay, note number 4. Do you see note number 4? Note number 4 is there is interest on capital as 36,000. Now, they are telling you the interest on capital. Who is paying the interest on capital? Who is paying the interest on capital? Paying it to who? Are they meant to pay it to them? No. So it means it's a non-allowable deduction. But the question is, how much is attributable to each of them? Here they have not broken it down for you, but they have given you a note. When they don't break those for you, they will give you a note like this. They say, all benefits and payments made to partners, where not specified, will be assumed to be shared in their profit or loss sharing. So if I want to know the interest on capital for one who has 40%, it will be 40% of 36. The one who has 20% will be 20% of that. And then I will earn 3 marks on that interest on capital. What do? I first add it back, I subtract it in the adjustments, and then take it to the individual account. The same applies to the salary. I first add back the salary of the partners, I come and subtract it in the adjustments, I take the salary to individual accounts. That is how it is. Okay, again, breathe for another 5 minutes. So at 30 minutes past 4, we are going to look at rental tax. someone online is saying, but they should bring us simple items that we know in English. Exam is a torture chamber. Okay, should we come back? Have you washed your faces? We are condensing 5 months of study into one day. So you can expect the pressure. Is the pressure creasing or creasing? It's creasing. Some of you are going to cut weight in just 2 days. They'll see you and they can't. Like some of you are like, but have I started reading? Yes, you have 2 days to change the. You have only 2 days to change the what? The fortunes. Eh? Eh? Okay, let's come back. It is 4:30, and we are going to look at a number on. We are going to look at the guidance on rental tax. Rental tax. Rental tax. I think rental tax is the easiest to calculate. Not so. Anyone who's, but you see, like I told you, we have old cadres and we have the new cadres. If you have done some of these exams before, you have some formulas that are still in your head. I want you to get them out. Because if there is anything that has changed so much, is rental. Rental has changed so much. So I want you to first unlearn, and then you can relearn. If you still have the 30% for individuals and the 20% deductions and the 75% deductions, please unlearn so that you can relearn. What I am teaching you now is what you're going to apply in the exam. Okay, so when it comes to rental tax, rental income can be earned by an individual, a partnership, or a company. And that is what they test you in the exam. You're either doing a number of an individual and it has an element of rental income, and you have to go on the side and calculate rental tax. Or you're dealing with a number of partnership like the one we are reading, where they had elements of rental income, and then you have to calculate rental tax on the side. Or you're dealing with a number of a company and it has elements of rental income, and you have to do a working on the side. Or you have to actually have a number that is separate and they are simply asking you about rental tax. Principle number 1 is that rental income is taxed separately from any other income. So do not be tempted to combine chargeable income. Because I told you, when you're dealing with an individual, if this individual, for example, has business income and has employment income and has other property income, you will determine the chargeable income and then combine them. And then you determine the tax at once. But if there is an element of rental income, please never combine it with any other income, because it has its own principles of taxation according to Section 5 of the Income Tax Act. Rental tax is calculated under Section 5 of the Income Tax Act. So, what do we do if you're dealing with an individual? I think it is the easiest for an individual. You have to take only 3 steps. For an individual, you take only 3 and you have your tax. Step number 1, determine the gross rental income. In simple terms, can you aggregate from day 1 of the year to the day last of the year how much someone has earned in rental income? If you're the landlord, you can know how much you have earned from your houses. Not so that is easy to do. Step number 2, irrespective of the income you have earned as rental income, every individual has one deduction. Every individual has only one, and that deduction is called the annual threshold, and it is only 2,820,000. It doesn't change. So whether you are an individual who has earned $1 billion in rental income, or someone who has earned 5 million in rental income, all of you have one threshold of 2,820,000. So you get that 2,820,000, knock it off from the gross income. Whatever remains is what we are going to tax, and we tax it at 12%. So step number 1, determine the gross rental income. Step number 2, remove the annual threshold 2,820,000. Whatever remains, apply 12% as the tax. You're done with the computation of an individual rental tax. I cross the partnership. When you're dealing with a partnership, you take 4 steps. The individual were 3. But for the partnership, you take actually 5 steps. What are the 5 steps? Step number 1, you first determine the gross rental income that was earned by that partnership. We are a partnership, but we also have apartments. We are a partnership, but we also have an arcade where we're collecting rent. So I aggregate all the rental income that has been earned by the partnership throughout the year. That becomes the gross rental income. Step number 2, I must divide this income among the partners using the profit sharing ratios. I must divide the what? This income among the partners using the profit sharing ratio, so that each of the partners has a part of that income. That is step number 2. Step number 3, each individual must be given the annual threshold, the 2,820,000. And the next step, the balance is charged 12%. So the only thing you do with the partnership is determine the gross and divide it among the individuals. After you have divided it among the individuals, behave like an individual. I hope that is also easy. Because with the individuals, we don't talk about expenses. And even partnerships, we don't talk about expenses. We only deal with income. If it is a partnership, divide it among the partners. After you have divided it, give each individual partner their annual threshold 2,820,000, and then whatever remains, apply 12%, and you're done. When it comes to a company, that's why I want you to pay more attention. When it comes to the company, you take these steps. Step number 1, determine the gross rental income for the year. And by the way, what I have not warned you about, if you received rental income that relates to another period in another year, that is not yet due for tax. Because I have seen situations where they tell you, you received rental income for the next 15 months. And you find the only period that is in this period is 12 and the 5, and rather, and the next part is in the other year. We are looking for rental tax for a year of income. So if income exceeds 12 months, you also have income that you have received in advance. That one should not be part of your computation. So you're only looking for the income for the year, not so. And you should always eliminate the advance income. Remember, for income tax and rental tax, we don't tax advance income received in advance. We only tax payments in advance if we are in VAT, not so. It's only in VAT that when you receive any income in advance, you will also have to have VAT on it because of the principle of time value, rather time of supply. So for the company, this is what you do. Aggregate all the gross rental income for a year, 12 months. Step number 1. Step number 2, you are going to remove all rental expenses incurred in generating that rental income. But those expenses have a limit. Those expenses have a limit. And that limit is up to 50% of the gross rental income. It is not the 50% of the expenses incurred, but 50% of the gross rental income. What does that mean? And I will illustrate that. Assume your gross rental income is 100 million. But the expenses you incurred that are related in generating that rental income that are allowable add up to 70 million. Can you claim all the 70 million? No. Why? Because they exceed 50% of the gross rental income. What would be the 50% of the gross rental income? What would be the 50%? 50 million, meaning you can only claim up to 50 million. So of the 70 million that you incurred, you can only claim up to 50 million and you lose the 20 million as expenses. But what if this time my expenses were only 45 million? But when I calculate half of my 100 million as income, half is 50. What do I claim as expenses? 45 or 50? I claim the actual expenses this time because they are not able to reach 50%. So when the expenses are less than 50%, you take the actual expenses. When they are more than the 50% of the gross income, we cut we forget about the expenses, but we look for 50% of the gross income, and we say that is the maximum you can claim. Now, after removing the deductions, whatever remains is called chargeable income, and we apply 30% on it. So for a company, we deal with the adjustment on the expense, and whatever remains, we apply 30%. So rental tax on a company is 30%, whereas on an individual and partnership it is 12%. The trick is on the expenses, please. We get the total expenses and we first match it with the 50% of the gross income. If the total expenses you incurred related to rental do not equate to the 50% that you've calculated of income, you claim all your expenses. After all, they are less than 50%. But if they are more than 50%, you ignore expenses and take the 50% that you calculated. Meaning that at all times, the maximum expense you can claim for rental expenses related to a company is 50% of the gross rental income. And there is nothing like notional expenses. We can't give you an expense that you did not incur. Some of the taxpayers think that because the limit is 50%, so what do? Without even looking at the expenses they incurred, they calculate 50% of the gross rental income and they want to claim the whole of it. The thunder that is going to hit them is coming very soon. Because that is the easiest audit to do. That is the easiest audit to do. So that is rental tax. Now, guys, that rental tax is for residents earning rental income here. So what if you are a non-resident and you have earned rental income here? What happens? You're a non-resident and you've earned rental income here. Don't we know some non-residents who have buildings here? Hey, example is who? Sudhir is a non-resident. Ah, Sudhir is a born of here. Sudhir is a double resident. He's more even of a resident than you are. So we have people like Ferdinand, who has apartments in where? Chanjanoso. So when they earn rental income, for them we don't charge them the way we have charged, the way we have calculated. But the guy who is collecting rental income for them, before they transfer it to them, they first charge them withholding tax at 15%. So for them, they charge them tax on withholding tax. So they will actually charge that income 15% before they actually give it to Ferdinand. So non-residents earning rental income will be charged at withholding tax at 15%. What if it is a resident who is earning rental income, but for a property that is not in Uganda? When he earns that rent, it comes as property income. It does not come as rental income. It comes as property income. It does not come as rental income, because rental income is for the properties in Uganda. That is land or buildings. Okay. Okay, so let's talk about capital gains quickly. Let's talk about capital gains quickly. If you realize there are not very many question sittings where you have missed
a number on capital gains. Am I lying? Have you checked your past papers? You will see capital gains coming through more often. Now, it is one of the areas that you can actually easily pass if you appreciate the principles under computation of capital gains. Because usually it is shorter and it is easy to actually get the issues around them. When we calculate capital gains, principle number one is that you must be able to have three things. What are the three things? Number one, you must have disposed of a business asset. You must have disposed of a business asset. And because you're entering the exam, I will give you what qualifies as a business asset. So that when you see it being disposed of in the exam, you know that now they are now asking for capital gains. So number one is when they are disposing of, for example, a building. When they are disposing of land. When they are disposing of shares. Then you know they want you to calculate capital gains. There are other two examples that you will see. If they are disposing of, for example, interest in a contract area when it comes to petroleum. The moment they tell you there has been a farm out rather, then you know there is capital gains that you must calculate. If they tell you that you have disposed of a former road vehicle, remember when you had a road vehicle, you divided it into two. The depreciable asset and the business asset. The depreciable asset was taken to the wear and tear up to the maximum of 60 million. There is an asset that you put aside. That asset qualified as a business asset, meaning if you also dispose it off, you'll be getting capital gains. Now, that is item number one. There must be a business asset. And I've given you examples of business assets. Step number two, you must look for consideration. If there's anything easier to get, is consideration. Because is there any number that you've seen where consideration is hard to find? I think consideration is easy. Because consideration largely is sales proceeds. How much did you sell this asset at? Sales proceeds. Item number three that you need, and where students find issues, is cost base. Because for you to get a capital gain, you compare two things. Consideration minus cost base. When consideration is more than the cost base, definitely you have made a profit. That profit is called the capital gain. When consideration is less than the cost base, you have made a loss. That loss is called the capital loss. Once you get a capital gain, the next thing is to apply 30% and get a capital gains tax or tax on capital gains. However, sometimes they can bring you a disposal of a business asset in number one. They can bring you a disposal of a business asset in number where you don't have to calculate capital gains separately or capital losses separately. They want you to calculate the capital gains, but don't tax it separately because capital gains is business income. So every time you calculate the capital gains before you attach the tax, you will come and add it on chargeable income if you're dealing with number one on business income. If it is a loss, subtract it from chargeable income. But most of the times, they actually bring you capital gains number separately as a different number. If it is a different number, after getting capital gains, you're going to go ahead and calculate the tax, capital gains tax. If it is a loss, you're not going to apply any tax. So what do? We said step number one, if they give you any number on capital gain, step number one is that you're going to establish the consideration. And this is the amount at which the business asset is sold, or the fair market value in a non-arm's length transaction. Have you seen numbers where they are saying the disposal was made to a brother, the disposal was made to a father, the disposal was made to a girlfriend? Or they are trying to tell you that that was a transaction not at arm's length. And therefore, they will give you the cost, they will give you the price that was paid, the sale proceeds, but they will also give you the market value. So at that point, you ignore the price, the actual price, and go for the market value, because that transaction is already influenced. It was not at arm's length. Or if the transaction was made in kind. I normally say these jokes. You have your girlfriend, you're excited, and you moved with your land titles in the car. And after getting excited, you go back and you're threatening, by that I can give you a land title. And you even go ahead and sign off the transfer forms. You only remember when the brains have come back, you know. In that state, the head is not working. So when the brains have come back, you remember I signed off the transfer forms. And the lady who is very smart, you would never recover it again. And you'll be broke from there and then. You count your losses, not so. Now that is a transaction in kind. The question is, then what is the disposal proceeds? We look at the market value. You have made a disposal, but there is no price, there is no consideration. So we look at the market value. That's how we look at the consideration. And our consideration is not something that is hard. Now, where I want you to pay more attention is where you calculate the cost base. Is where you calculate the cost base. If it is an asset like land, you will get the cost that you incurred in purchasing that land, plus all the incidental costs that you incurred, whether transfer fees, whether legal fees, whether stamp duty, whether all those costs that you incurred in the process of acquiring that land. If you have put any developments on that land, the costs of those developments also added onto the land, because you have been incurring costs on this land. And you're saying, when I am going to sell this land, I want to recover my costs. So you aggregate all the costs. That becomes your cost base. But before you remove that cost base from consideration, you ask yourself, have I owned this asset beyond 12 months? Have I been with this asset beyond 12 months? If you have been with that asset beyond 12 months, you're going to do what you call indexation. So the cost base ceases to be just an absolute cost base, but you must apply indexation to ensure that you bring it closer to the consideration. And the formula for indexation is here. So I'm assuming that you already have the cost base, but you have remembered that you have been holding this asset for more than 12 months. So before you remove cost base from the consideration, you first index that cost base. How do you index the cost base? You get that cost base multiplied by this ratio, the CPID over CPIA. In simple terms, don't be confused by the nomenclature. CPID and CPIA are just consumer price indices. And these are published by the Bureau of Statistics. Even when you go to their website and search for consumer price indices, you will know them. Each month, they have specific consumer price indices. So what is CPID and what is CPIA? The CPID is the consumer price in the month of sale. If I bought my land 3 years back, and I am selling it now in the month of December, they would have given me the consumer price index for the month of December when I am selling that land. That becomes my CPID. The CPIA is the consumer price index in the month prior to the month in which I actually incurred the cost. That's why they say CPIA is the consumer price index in the month prior to the month in which the costs were incurred. And sometimes the examiner gives you the CPIA in the month, in the very month when the costs were incurred. So if I bought this asset in the month of November 2022, the CPIA would be the consumer price index in the month of October that year. Altogether, it is the consumer price index in the month prior to the month when I incurred the cost. When I bought that land, what was the consumer price index prior? That is the CPIA. The moment I get the cost base that I had, I multiply by CPID over CPIA, I'll be getting what we call the indexed cost base. And it is the indexed cost base that I remove from the consideration to get my capital gains or capital losses. When don't you index? You don't index when you have not held this asset for more than 12 months. If I buy an asset within 12 months, I have sold it, I don't have business indexing, because indexation is for removing inflation. And statistics show that you can only calculate inflation when you have held an asset for more than 1 year. If it is less than 1 year, you don't have business indexing. That is on an item like land, meaning the formula will be consideration minus indexed cost base. That is for land. What if it is for a building? And you know land does not have any capital deductions, not so. Land does not have any capital. So from the time you bought that land, you've never gained any capital deductions on that land. That's why there is no capital deduction that reduces the cost base. However, if you have an asset like land, rather like buildings, you're going to first ask yourself, from the time I constructed this building, have I claimed any capital deductions? If you have claimed any capital deductions, the capital deductions must be removed from the cost, because we cannot give you an allowance twice. Any capital deductions that you have claimed on that asset must be used to reduce the cost base before we can do the indexation. Because an asset like a building qualifies for IBD. So if they have already given IBD to that building, it means you get the original cost, construction cost, minus the IBD that building has already benefited from. And then you remain with the cost base, less IBD. And then that net is where you index if it has already been 1 year plus. In simple terms, a business asset that has already qualified for capital deductions, the capital deductions must be knocked off the cost base, because the capital deduction is already a benefit. So we cannot give you a cost which we've already reduced with capital deductions. Okay, so after you have gotten your capital gain or capital loss, the last is that you must be able to calculate the tax on capital gains, or if it is a loss, you don't apply any tax. I am assuming that it is a separate number. I have gotten my consideration minus cost base. The result is a gain, and I will go directly and apply 30%. Whether it is an individual, whether it is a company, whether it is any person, you apply 30%, because we see it as an additional income. If it is part of the number one, if it is capital gains, go and add it on chargeable income. If it is capital loss, go and subtract it on chargeable income. I am now going to entertain some of the questions. Any other specific questions before I can close this chapter? Questions, you can now shoot. You have now 15 minutes of your private questions that I can answer, and then we close this session. So I'm going to allow any questions that come within the... If we don't have any questions, then I'm going to break off and pray for you. Do we only need the prayer? Can we pray and go home? I am available to answer all your questions in this period between now and 11th until you enter the exam. My WhatsApp number is, let me write it here. My number is okay. Let me write it here. So that's my number. In case you have any questions, please, you can always ask. I am always available until midnight. After midnight, I am also doing some other work. So we can, I don't know how you guys online are going to miss our prayer. We are going to hold our hands and pray for each other, and then we can get ready for the exam. Otherwise, I wish you all the very, very best. Please don't sleep between now and 11th. Read and only do enough. 2 hours enough for a sleep. Not so. Just sleep 2 hours and the rest, run through these numbers and you'll be good to go. Do you have any pastors or pastor in the house? Want someone who can pray for us? Please stand up and hold hands together. If you miss holding your neighbor, you might be the one who is challenging our 50%.
The questions are in the chat. Kindly check.
Ya tidak berapa, mainnya wamuvuza.
Are we done?
Naffe tusabe bannange. Muli eyo bali basaba ffe tetusaba. I don't know whether we are safe.
You lead us in the prayer.
Then the questions in the chat have not been answered too.
Shall we pass those
Questions can
questions?
prayer is key.
We pass those questions.
Guys, all the best and success in your exams.